Hello, my name is Craig Tashton. I'm with Fairway Independent Mortgage. We are a local branch here in Needham, Massachusetts. Our main office, corporate office, is out of Madison, Wisconsin. We're part of a nationwide branch network. And what I wanted to show you today was the benefits of owning versus renting. So if you're thinking of renting or continuing to rent or signing a new lease, you may want to consider at least thinking about or working the numbers to see whether it makes sense for you to purchase, whether you're purchasing now, 3 months, 6 months, or 1 year from now. So in column number 1 here is the rent column. $1,300 per month is the rent that I chose. You might have other costs like either rental insurance or other miscellaneous costs of about $30 a month. So total cost of $1,330. Let's say if you did a 7-year adjustable in order to keep the interest rate low during the first 7 years of the loan, with a minimum of a 5% down payment. The mortgage itself, the principal and interest, would be $1,320. Between taxes, insurance, and mortgage insurance, we have approximately $600 per month for a total payment of $1,900 per month. Now that obviously is more than your rent, but when you factor in the tax benefit, and I used a conservative 15% tax bracket here, and also how much principal you would pay down the loan on a monthly basis. So the pay down of the principal is like paying yourself. You're paying your loan down. So on a net basis, when after you figure in these two, it's less than what your cost of rent is, because both of these things are a benefit to you which you do not have when you rent. So once again, over here, $1,330 for the rent, $1,264 net payment on the mortgage. So this analysis is designed to show the benefits of home ownership. The rent column shows the total rental cost one might pay, while the 7-year column reflects the proposed net payment after tax benefits and principal pay down if you were to purchase of a home. What this section here is trying to show you, is illustrate to you, is over the next 5 years, this is how much you would pay in rent, over $81,000. Over the next 5 years, you would gain $28,000 in equity, because this is how much you'd be paying down your loan by, plus a modest 1% depreciation rate. I use the same 1% here to show the same inflation rate versus appreciation rate. So basically the commentary here is, can you afford to continue to pay rent? Over 5 years you will pay about $80,000 in rent, factoring a modest increase of inflation. If you own, you will reduce your mortgage balance by about $28,000 in only 5 years. If you were to sell the house in 5 years, assuming a modest increase in value, you would walk away with $28,000 in equity, over and above your cash investment of 5% down. The long term is where you see the greatest benefit of the long term. Let's say you kept this mortgage for 7 years, and kept this property for 7 years, and considered selling it after 7 years. If you left your money in the bank, you'd have a little under $27,000 in the bank, based on a very modest return that you get, return on your money that you get in the bank. This is if you had $25,000 to work with when you first started 7 years ago, this is what it would be worth 7 years later. Not to mention the cost, tax cost here, and inflation as well. If you had this property and sold it after 7 years, you would gain $93,000 in equity in your property. So if you would like to have a customized analysis, please give me a call at the number at the top right hand page of the page, and I can help you with this to see if it's worth it to you. Thank you.